The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Welcome to our Investors Observer members only workshop. My name is Bobby Rains. I'm the senior analyst here at Investors Observer. So let's get started. All right, so our agenda today looks the same as it normally does. We're going to do a little market update, talk about what's going on in Investors Observer. Actually, we don't really have a lot to talk about this time, but I think we will have some stuff to go over the next time. So yeah, we have some things going on. I'm just not ready to get into specifics is what that means. And then member-driven content, questions, site demonstrations, etc. I do have a couple of slides that I put together based on a question from a subscriber. So we'll be getting to those after we do the market update. And then any other questions you have, put them in the question box. As always, if you have something you'd like to see us talk about during the webinar, certainly we're happy to answer questions anytime, but if it's a question you think other people might enjoy seeing an answer to, or the sort of thing that you feel like is better explained with slides than just through email or a phone call, that's exactly what these sessions are here for. So just put those questions in and mention webinar somewhere in the email, and we will, in most cases, send you an email with an answer and then also keep it for the webinar. Yeah, mention workshop and we'll prepare slides for things. All right, so market update. We still have, I feel like we've been looking at these same two lines for months now. The key levels here are at 2750 on the S&P 500 and then another sort of firmer one at 2800. Luckily, the 100-day moving average has served as support here a couple of times. And then, the 50 has sort of stepped in occasionally as well here. But yeah, this is pretty much where we are, and it's very much driven by technicals, but also, trade. I mean, the big turnaround today is 100% about the trade announcements from yesterday. So that's kind of where we are with that. All right, so if we look at the major indices, you see this divergence here. I brought in the Russell in addition to the three that people normally look at, because it sort of helps to highlight how much of this is about trade. We've got the S&P 500 and the Dow Jones, both on either side of break even for the year, essentially. And then the Russell, which is small caps, and the NASDAQ doing pretty well. Tech and small caps are essentially the things that are working right now. And that is largely about trade, right? You look at Procter & Gamble or some of the other companies that are in the Dow, they have a lot of international exposure, and so they get hurt there. The S&P 500 has the same sort of things going on. So let's look at those major indices because there's some divergence there as well. So this white line here is the NASDAQ for the last 3 months. It's up about 8%, but we have some pretty wide divergences between the top and the bottom here. So the top is Netflix. Netflix, I feel like is safe to call an outlier, right? Like there's no magic bullet to getting a 40% return over any period in the stock market, really. But it does illustrate the point about trade in that Netflix has no physical goods. It's consumer focused. A slowdown in business spending isn't really going to hit Netflix in the short term at all. And then, they're not carrying anything across borders. This next guy here, MDSO, that's the one of the biggest companies in the Russell 2000. They're a software as a service company. They focus on like software for clinical trials. So again, not a lot of physical goods crossing over borders, not a lot of international exposure. Those are the sort of things they're doing well. And then this next guy here is CRM, that's Salesforce. Again, right, they're a big cloud player, primarily in the US. Tariffs have so far stayed away from services. At a certain point, if you get a serious slowdown in business spending, CRM could be hurt, but they've held up pretty well. And then if you look at these last two, Cisco and Qualcomm, right? Both of those guys are making physical hardware. Some of it's manufactured overseas. Those are underperforming the NASDAQ. So even in the NASDAQ, which has been relatively much better than the other major indices, there is quite a bit of a divergence there between what, the sort of software cloud kind of players and the, anybody shipping physical goods across international boundaries has to be at least a little bit worried about tariffs, and especially in the tech space where there's so much international supply chains. That's why you see the weakness there. All right, so that is that. And then what else is going on in the markets? Producer price index came out this morning. It was a little higher than expected, even outside of the food and energies. So that's another sign inflation is rising. More evidence for the Fed to sort of keep doing what it's doing. Trade, we had new tariffs announced yesterday. This list of things looks like there are some things that are a little bit more likely to hit the consumer. The first list was a lot of like industrial parts and things like that that are hard to directly tie back to the consumer. But once you start getting in clothing and food, those are things that people buy directly. So that will start to show up. Both when you go to the store and also in things like retail spending and things like that. It either has to come out of margin or through higher price. And then China said they're going to respond. It turns out that we don't actually export enough things for China for them to respond dollar for dollar. So how exactly they choose to respond is something of an open question, I guess, until they make that announcement. And then, small caps and tech. I didn't even change that bullet from the last time we did this, which has been a month ago now. That's still the story, which is not to say it's not volatile, even in those sectors. But those have, as we looked at a couple of slides ago, there's been a lot of relative outperformance in that space compared to, your industrials and mega caps. All right, so let's get into the questions. So our first question is from Jason, who said it'd be great to learn how to recover from a losing diagonal spread and how to look for new options to sell against it and how to recalculate the net debit. So we're going to have a couple slides about that. And again, any questions about this or anything else, just throw them in the box there and we will get to those. Special thanks to Rob Silverman, our member success coordinator for the clip art today. Because diagonal spreads and covered calls also can, especially in a market like this, need a little bit more management than what we saw last year. Last year, it seemed like every time we, had one of these trades, the sold call would get assigned, or we'd close the diagonal spread, sometime before expiration, and it was no problem. We didn't have a lot of these sold calls expiring. This year, with the choppiness, it has been different. So we are going to talk about how exactly to deal with that. So, one of the key things from is diagonal spreads work a lot like covered calls. You can keep selling calls against that bought leg until the bought leg expires. Just remember that you want your net debit to be less than the strike width, and we'll look at that with a couple of examples in a minute. So the net debit is pretty simple. It's essentially just the sum of all the legs. So when you open a diagonal spread trade, you buy one option and then sell a different option. So if you net the credit against the debit there, that gives you your initial net debit. Anything you sell against that long leg after that lowers the net debit. If you roll, obviously you have a credit and a debit. But that's the gist of it, right? If you can keep your signs in place, you just net up all the legs, and that is how it goes. Now the harder part is timing and picking a strike. You don't want a strike that's too low. Because then if the stock goes up higher than that, you've capped your return at a level that maybe you're unhappy with. But you don't really want one that's too high either, because you don't want to sell a call that doesn't bring in any money. Turns out the commission for selling a call is the same whether you sell it for $1 or 25 cents. It turns out as a percentage, though, the commission is a lot heavier price to pay at 25 cents than it is $1. So you'd like to get a relatively big credit at a relatively high strike, which is hard to do. All right, so let's look at some examples in terms of things that we've done in the portfolios here. So these are all trades we still have open. Square at last check today was not at the 66 level of our sold call, but was trading with a green number. This one's pretty simple. We sold a 66 initially. It expired. We sold another 66. In this case, the strike width stays the same. We're still at 47 by 66. The net debit dropped. Essentially, right, 92 cents comes off the net debit. So we went from an $18 debit to 17.08. And that increases our target return from $1 to 92. Remember, the target return or the target profit in a diagonal spread is the difference between the net debit and the strike width. So if you have a $19 strike width and you go from 18 to 17.08, your net debit is going down, your target profit is increasing. So that's how that one works. That's pretty simple. Honeywell. This one is a case where we tried to be a little bit more defensive. We didn't shoot for trying to get a higher return. We tried to take the bird in the hand in this case instead of theoretical bush birds. So in this case, we were at 28.60 on our initial net debit with a 150 sold call. But when we came back, we sold a 148. So we lowered our strike width from 30 to 28. And so our net debit, our net debit went down to 27.90, but because our strike width went down by $2, our target profit fell from 140 to 10 cents. So this is a case where we're basically looking for a graceful exit. We'll see on Friday. I think Honeywell still has to rally a little bit to get back to 148. But we'll see on Friday where we are with that, and then we'll go from there. But you can see the sort of difference in approach here. We could have taken a smaller credit and tried to be further out of the money, but in this case, we decided we wanted the 70 cents more than we wanted to try to keep or expand the initial target profit. And then we have KRE, and this is a fun one because we've sold a couple of different calls on it. So originally we were at an $18 strike width with a net debit of 17.10. And so that call expired and we sold a new call, moving our strike price from 65 down to 64.50. But we got 70 cents for that. So our strike width actually narrowed, but our target profit actually increased because the net debit shrunk by more than the strike width. And then that one expired and we sold another one. In this case, we tightened it back up a little bit. We sold a 63.50, right? We shrunk the strike width by $1 in this case, but we only brought in 62 cents for that one. So now we're down to a 72-cent target profit. So I mean, essentially, right, keeping track of the net debit is pretty easy, right? If you can keep track of your credits and debits, you just net them all up, and that is your net debit. So every new call you sell, that's just money that comes off your net debit. And now one thing you want to keep in mind with this is the stock break even. And that's pretty simple. It is basically just take the strike of your bought call, so in this case 47, and add the net debit. So with KRE, we bought a 47, and then we sold, our net debit was 17.10. So our initial break even was $64.10, which, if our initial target profit was 90 and we were at 65 with our sold call, it makes sense that our break even would be 90 cents below the price of that call. But as you're looking for a new call to sell, you can kind of keep track of where your strike price is in relation, where that strike price is in relation to your various theoretical new net debits. And yeah, I mean, this is what we do when we're managing the portfolios. We go through pretty much anything that's uncovered a couple times a day and look and see what we could get and what our options are and where we think, where we think the stock is likely to be and what the sort of risk reward there is. And that's why we have some that have been uncovered for a while, and that's why there have been some that we covered up again relatively quickly, because it was just much more attractive for those. All right, Claudia, I knew this was going to happen. All right, so if anybody has any more questions about this, put them in the box. We have a question from Claudia here about a different diagonal. I knew we were going to get this question, so I did not put slides together for it because I ran out of time this afternoon. But we have, it turns out, 2 positions on Skechers. And Skechers has not done well. We have, let's talk about the diagonal first. All right, so we have sold a couple of calls against this one, but Skechers, as you can see from the chart here, took a big hit shortly after we opened this trade. So in this case, we're down 727. This call is set to expire on Friday, and the stock is right around 31. We will see where it ends up. We may end up having to buy this call back because Skechers reports earnings. Yeah, our data provider is, the reason we were in this position in the first place is our data provider seems to have a hard time getting an earnings date for Skechers. We've since learned a lesson there, and it seems like Skechers is probably going to report on or about next Thursday, which is the 19th. And so in this case, in the diagonal, I really don't want to get assigned at 31 and walk away with an extra $1 from here. That ends up with a loss of $7. So what I'm considering doing here, and we'll see how it trades leading into earnings and what the pre-earnings news looks like. But at this point, we may hold it through earnings. Right, the bought call is set to expire on that Friday. So essentially, it all comes out to, right, how are their earnings going to be? If their earnings are good, we can look at the chart here, and you can see Skechers has, there are some big gaps on this chart that tend to happen about once a quarter or so. Right, so it could go big on earnings, or it could go up big or down big on earnings. At this point, we've already taken most of the loss, so there's not. It doesn't seem like there's a lot of risk. I'll send out a note with an explanation for how to get out of it if you don't want to take it through earnings with us. But in this case, we've already taken most of the loss. So on the diagonal, it seems like it's all upside from here, right? Like we could give back $1, or we could try to win back, some of this $8 we have at risk. So that's the plan for the diagonal, and I'll send out a note, certainly before Friday, about what to do with that short leg, and then we'll get into, people are certainly welcome to close it up before earnings if they're so inclined. We also have the covered call. Now, in the covered call, the situation is similar but different. In the covered call, we are down roughly the same amount, and we still have a $31 sold call. But I'm less interested in holding this through earnings because we can still lose a lot more than $1 here, right? Like if Skechers goes to $20, the most we lose in that diagonal spread is essentially the $1 we're up above our $30 bought call at this point, which I wouldn't be happy about, but it's $1. If Skechers goes to $20 here, we've lost $16. We've lost an additional, well, not $16. We've lost another $11 roughly if we're at, $5.70, so somewhere between 11 and $12. I'm not interested in putting more of that money at risk. So we'll be closing this position Friday or early next week, depending on what the market looks like. So this is a case where we have a diagonal spread and a covered call, and they're similar, but we're going to treat them different, and that's because there's a lot of downside still in the covered call, and there's not a lot of downside still in the diagonal spread. So that's a case where I always say that diagonal spreads are very similar to covered calls, and they are. But this is a good example of a way that they can be different. And obviously nobody's excited about having nothing left to lose on that diagonal spread, but it does leave us an opportunity to, where we have sort of a ticket where we could see ourselves make back a lot of money Friday morning on that Skechers call. We'll just have to see how earnings plays out. All right. Tony has a question about trading credit spreads around earnings. I will pull that out for next time, Tony. We have done that before. I don't have I don't have those materials at my fingertips, but I will make a note to pull that out for next time. Any other questions that people have? All right, so Rick has a question about one of our other problem children, which is bots. Yeah, Rick, this is unfortunately another trade casualty. I mean, we also sort of got into it at the top, which is unpleasant, or closer to the top. But yeah, this is an ETF, and it's unfortunately has pretty low volatility, which was attractive at a time. It is less attractive when you're trying to repair it. But yeah, it's been in kind of a trading range, unfortunately. Well, yeah, it's up a little bit here recently. But yeah, it's been in kind of a trading range. We're watching it. I'd like to see it get back up somewhere in this area. And then we may look at cutting it loose, or maybe the volatility will increase to a level where we can sell another call on it. Unfortunately, there's not a lot of volatility, and it is it's really hard to repair something like this that has not much volatility and also not many strike prices. There's not a ton of options available here, meaning that we don't have too many things to choose from. So that makes it a little bit more difficult to try to repair these things. But it is a thing we're still watching. Generally, robotics and related sector ETF I like generally. Unfortunately, there's some amount of shipping physical goods across international borders there, and so we kind of got caught in the trade war there. But yeah, we're still working on it, and we'll provide updates when we have them. All right, so Tony has a question about credit spreads in the morning. That seems like you're talking about our investors keyhole service, Tony. So we can go over here. They come out typically shortly after the open, the first two. Today it looks like we were 10:32 and 10:38 Eastern, and then unusual options activity was at 12:30, we'll call that, and the insider was at 12:51. And if we go back to yesterday, we probably see a pretty similar pattern. 10:08 and 10:19. So yeah, usually in the 10 o'clock hour, the morning update has a trade that comes out before the open, if you're subscribed to that package, but nothing else comes out before the open. I mean, trade idea generally is updated before the open, but investors keyhole trades come out after the open because we need to get a live price, and they're usually about things that are moving, and you can't really get a good option price on something that's moving before the open. I mean, you can kind of guess sometimes, but that can be difficult, and we'd rather wait for the open and get a good price where we know people can get filled than try to guess and just send something out and hope it works. All right, so we did get another question from Ted that I didn't put into slides, but he was asking about trades in the trade idea generator and being further in or out of the money. And so there aren't really repair strategies for the vertical spreads. Unfortunately, everything expires at the same time. So typically with those, we have found it works best to just close them up when it seems like they're going to go bad. Try to look for a graceful exit, whatever it is that looks like. But the covered calls and the diagonal spreads, and I mean, really the short puts, right? If you sell a put and it, the stock is put to you, now you have a long stock position and you can turn it into a covered call. So for all of those, a thing that you can do, and let's go over here, is you can just use the out of the money covered call calculator to try to help you find a call. If you hit position repair and then put in, what was that net debit back here? So 47 plus 1578, 6278. Even if we're doing a diagonal spread, you can still say your cost basis is 6278 because that is your break even. And if you want something further out of the money, do income generation. Further in, position repair. And so yeah, there's. I have a question about that date. But yeah, that's not exactly the call that we sold. It's down by $1 in terms of the strike price, but it looks like it works. So yeah, you can use this tool to try to do that. And if you do income generation, you'll get one that's further out of the money. Unfortunately, especially with ETFs, things that are further out of the money, ETFs are less volatile, which makes them attractive, but it also means they have lower option premium. So, probably you don't want to sell a call that doesn't expire until December against your diagonal spread. That particular diagonal spread, the long leg expires well before December, so you definitely don't want to do that. So the position repair piece might work better for you there, but with something like a square, you should be able to get a sold call that's much shorter than you would with the ETF. All right, so yeah, okay, so that goes out to August 2nd, which is maybe a little far, but not too bad. 3 weeks. That's not too bad. Okay, yeah, so that is a tool that you can use to all right, yeah, thanks, Rick. That looked like it was off by a date. We'll get that fixed. All right, any other questions? Or yeah, bugs that you've noticed. We'll certainly take those too. All right, so Tony has a question about MU. I assume you're talking about full swing stocks today, Tony. I got a chart here though. Yeah, the gist of it was the opening looked pretty rough this morning, and it rallied a little bit, and we decided we would take it there. Last I looked, it was down from where we got out, but didn't actually hit the stop. But it seemed like our stop was definitely in play, and we would rather have not lost that extra 1.25%, 1.5% from where it was sitting when we closed it. So we opted to take it there. We manage each position on a case-by-case basis, and keeping your losses small is probably as important a part of trading as actually having big winners. If you have big winners and big losers, you're not going to get anywhere. So yeah, I mean that was what we were trying to do. Is it looked like we could have a full 4+% loss if we got stopped out. And so we took the early strength as a chance to get out. It turns out, it looked like the market was selling off into the close a little bit when I came out here. I'd be surprised if MU got that down that far, but yeah, it seemed like there was a chance we were going to get stopped out as the day progressed. So we decided we would save the extra 1+% in terms of loss. I mean, yeah, we have a relatively complex system for choosing our stops. Some of it's technical, some of it is a little more formulaic is the wrong word. We use a combination of factors when choosing our stops. Not right. That's why we have different stops for everything in full swing stocks. If it was just 5%, it would be pretty easy. But no, each stock has a stop that we feel good about. When we put it out. So some of them are wider, and some of them are narrower based on what we think is an appropriate sort of risk and reward for each individual position. So yeah, we don't have a stop loss percentage is I guess the shortest answer to that. But yeah, we do have a system that we're using to sort of try to calculate those. And then yeah, I mean closing trades is much more art than science, both on the upside and on the downside. Rick, I don't have that at the top of my head. We do have, there is it's a little bit difficult to get to. It's outside of the paywall. Yeah, you can go to the closed trades here, and yeah, I mean you can download a CSV of all of the closed trades. The choppy market has been tough recently. Yeah, so Rick, we do have a performance that was updated probably as of July 1 on the marketing page, certainly. And I think the closed trades are also available from the marketing materials. Yeah, it hasn't been what we would like, quite frankly. The market has been tough, but we're working, and we're not altogether dissatisfied with it. Obviously you'd like for every trade to be a winner. You'd certainly like to avoid, big losses and getting stopped out on things the same day. But this market has been challenging. We stand by our performance. It's posted there certainly for people to see. And all of those products have the closed trades available as well. But yeah, I don't know the number off the top of my head, but it is on a marketing page. So if you go to memberships and then under add memberships, you should have full swing stocks. You should be able to get some idea about it from there. All right, does anybody have any other questions? Our next workshop will be on, it's 3 weeks from today, which I believe is August the 1st. Again, at 4 p.m., we will put up a recording of this presentation and a copy of the slides, probably tomorrow. And then we'll have a link to register at that point, and then we'll send out invitations prior to the workshop, as we did, with this one. But yeah, other than that, if anybody has any questions, I booked the hour. So if you have questions, fire them at me, please. Otherwise, we can wrap it up. All right, well, I don't see any more questions coming in, so I'm going to go ahead and sign off. I hope the rest of you have I hope all of you have a good afternoon, actually. And yeah, we'll talk to you again in 3 weeks, and don't be shy about reaching out if you have any questions. This help button here or our phone number at the bottom of every site are great ways to get in touch with us. Thank you all for coming, and we will talk to you later. Bye.